We're very pleased with our performance in the first quarter of 2016. It's the culmination of really two things. One is the work that we've been doing behind the scenes on the funds and the products in a variety of different ways, and also with the market gravitating more towards our style of investing. And we think we're really well positioned for a continuation of that going forward. We saw a dramatic turnaround in our performance in the first quarter of 2016. And the good part about it is it's starting to bleed into our one-year numbers and in several cases our three-year numbers as well. So we're pleased with the turnaround we've seen. During the quarter, we saw the market rotate away from many of the types of companies that had done so well during the previous years. So the market gravitated to companies that have real earnings. The market gravitated to companies that have low valuation. And most specifically, we saw the market really gravitate to value-type businesses. And we saw a switch in the market from growth to value, something we hadn't seen in 5 of the previous 6 years in the Russell 2000. So we think we're at the beginning of what is going to be a multi-quarter, in fact, multi-year process in terms of value outperforming in the overall market. We have just gone through last year a 2 standard deviation event in terms of growth outperforming value, and we think the market is just beginning to rotate back to value. Value did outperform not only for the quarter, but has actually outperformed over the past 9 months during the corrective phase of the market, and we think that actually has long legs as the market rotates from non-earners to earners and focuses more on valuation in a way that it hasn't over the past several years.
We're very excited about what we saw in the first quarter of 2016, and it's really a culmination of a lot of things, both related to market dynamics, but importantly to things that we've been working on within Royce. Going back 2 or 3 years, we began a very close evaluation of sort of all the things that we do at Royce, and we set in place actually a quarterly process of evaluating strategic initiatives of the firm. So we began by rationalizing our fund lineup and really making sure that the products that we have fit where we believe they fit in terms of the solutions that clients need, and appropriately that the teams associated with them were focused exclusively on those efforts so that their work was being appropriately concentrated and focused in a core zone of expertise. And I believe by really concentrating the scope of work of our PMs in core zones of the market and the investment discipline to which they are best suited was clearly contributing to some of the positive effects that we saw in this turn in our performance. We constantly look at our PM teams, how they're supported both in terms of analytical resources and quantitative technological resources. Over the past couple of years, we made very purposeful decisions to add analytical staffing to support our PMs in a range of activities. We also are continuously exploring outside technological resources, quantitative resources, and generating some internally as well. So we use both internal and external applications to give a variety of lenses for our portfolio managers on their portfolios. Ours is a very active process. It's bottoms up in its orientation, very, very fundamental. But when you construct a portfolio in that way, you end up with a bunch of aggregated risks that might be expressed in a variety of ways in the individual research that we do on specific companies. So we've added also lots of tools that allow us to explore what the aggregated risks are in our portfolios from what is a very idiosyncratic investment process which we employ here. This was obviously a big move that we experienced in the first quarter, and importantly, it's not because anything radical occurred here at Royce. We just enhanced some of our processes around a core discipline that we know that works over time, and the market really adjusted very, very abruptly in the quarter. But as we've seen over time and in our experience, these adjustments take not just a quarter to play out, they take a year, 2 years, 5 years. So we believe we're in the early innings of a long runway for a return to normalization in capital markets activity.